Welcome, everyone. This is John Pocaroba. It's a cold and snowy day up here in the Northeast. I hope everybody in the Northeast is staying safe and warm. Others around the country and around the world, I hope you're having really much better weather than we're having in the Boston area. So, general market update, lots to get to today. So let's get to it. Again, I am an amateur investor, individual growth stock investor. I'm not affiliated with IBD. Or MarketSmith, though you will see MarketSmith charts throughout the presentation. And here's our agenda for today. Really three pieces. One, the big picture overview. Two, what I call the January Trifecta. And three, I want to talk about some market scenarios, what we're seeing in the markets, and a couple of scenarios, what we might be able to expect in the future. So the big picture overview. Again, just a quick refresher. I'm a big believer in the super cycle, which started in 2009, which could go as far as 2035. If you have not been familiar with the super cycle, go back to my videos in the previous month or so, and you'll see a detailed explanation of those videos about the super cycle. I've been showing this chart, which is a really long-term monthly chart of the NASDAQ in the context of the super cycle. Just shown some really big picture trend lines. And I've been saying for at least a year and a half that in the super cycle, there will be bear markets, as you can see. And I've been saying all along that we could come all the way back down for a 30% correction or bear market and still be within the context of a super cycle. And I know there's a lot of consternation about rising rates. There have been periods of rising rates when growth was in a stealth bear market in 2015, 16, but the market found its footing even during those tough periods and moved higher. So this is a chart that I actually tweeted out during the week. And somebody asked me a little bit about how I define pullbacks, et cetera. So I just tried to show on this January 19th chart of the NASDAQ, I consider a pullback in an uptrend a 3 to 5% pullback, and I'm just showing levels compared to the NASDAQ high. An intermediate term correction is really like an 8 to 12% pullback, which is in this yellow orange type of zone here. Once you get a correction 8 to 12%, you really do need a follow-through day to kind of reset the uptrend. A bull market correction would be a minimum 10% pullback and a close below the 200-day moving average. A bear market, kind of a standard definition is it's 20% off the highs, and I've shown that line in pink. And then a major bear market would be a 25% minimum off the highs and a close below the 200-day moving average. And usually you'll get at least 2 failed follow-through days within a 3-month period of the peak. And then the blue line is this support area that I just showed you on the long-term chart around the 11,000 level to remain in the bull super cycle thesis. So let's talk a little bit about the January Trifecta. Now, all of these statistics I'm going to share are from the Stock Traders Almanac, the 2022 version. There's really three pieces. One is the Santa Claus Rally Indicator, and that is taking the last 5 days of December plus the first 2 days in January. You'll usually have a positive gain, a rally. Since 1950, the gains have been on average about 1.3%, pretty consistently. But when the indicator Santa Claus does not come, it has preceded corrections or periods like bear markets. So that's one indicator. The second indicator is the January 1st 5-day indicator. And that's when you look at the very first 5-day totals for the first 5 days of January. If they're positive, that means the year, the entire annual year gains will likely be positive. And this has held up 86% of the time since 1950. And the third is the January Barometer. And that is when the month of January has a positive gain. It usually means the year will end up in positive territory. And that has a 73% accuracy since 1950. So let's take a look at this year as we've just about closed January. So they're the statistics for the Santa Claus rally this year. So here's the actual dates. And the final tally was 1.44%. It's actually the best showing since 2018. You can see the average has been 1.3. So that's pretty positive. Now, the first 5 days of January this year, which typically is a pretty accurate indicator, you'll notice that the final tally for the first 5 days this year was minus 1.87. It was the worst showing since we had a 6% decline in 2016. So it's important to note a couple of things when you really dig into the details. The last 25 down first 5 days resulted in 14 up years and 11 down years. So it's a very mixed record over the last period of time. Also, when you parse it a little closer and you look at midterm election years, of which there were 18, 8 of them followed the first 5-day indicator. So it's really, again, mixed record, not a great record in midterm election years. This year is a midterm election year. So the January Barometer, let's look at this. Since 1950, it's 84% accurate in predicting if the year is going to be positive. Well, what's interesting, in 4 of the last 6 years, the January Barometer has been wrong. In 2016, 2018, 2020, 2021, these were cases where how we started January did not reflect how we finished the year. Now, unless the S&P is going to have an incredible day on Monday, the 31st, January is going to be a negative start to the year. As I mentioned, midterm election years, very mixed. But what has been noteworthy is every down January since 1950 has preceded either a new or an extended bear market, or a flat market, or a market that had a 10% correction during the year. And the average correction over that period of time historically is about 13.2%. This chart is taken from the almanac, and in the blue line, it's showing the midterm election years. What's the seasonal 1-year performance of the S&P 500? So in midterm election years, you can see the year starts out slow. January and February tend to be down. Then there's a recovery rally taking you into April-ish. And then again, there's a wave back down lower, kind of the summer doldrums. And eventually you'll see that there's a kind of an end of the year rally in the seasonally strong period from October to the following December. So it's an interesting just thing in the backdrop to have in your mind. What does this all mean? Well, this year, the Santa Claus rally indicator was positive. The first 5-day indicator was negative, but it has been mixed, so I wouldn't put too much credence in it. And then the January Barometer, again, is mixed. Not been that accurate the last 5 years, and it's midterm election spotty. So I think all in all, I wouldn't get too hung up on the January trifecta at all. It's just something that I thought might be interesting to share with you because some people really believe in the strength of these indicators. So let's turn ourselves to a couple of fairly quick assessments of market sentiment. So the first thing I want to look at is the American Association of Individual Investors. These are basically retail investors, and it's the number of people in the survey that are bullish minus the people in the survey that are bearish. So if you're above 0 in the green zone that I've highlighted, that's generally a net bullish opinion versus net bearish in the pink zone. And you'll notice that what was interesting is 2 weeks ago when I filmed this video, the bearishness had not even exceeded the amount of bears that we had in September. And I think I mentioned we might have a ways to go. Now, recently, the bearishness has really risen to more of an extreme level among individual investors. You'll notice that we're all the way down to levels that were from March 2020 and April of 2020. So this is actually a positive sign that we're seeing an extreme reading in this particular sentiment indicator. Now, I will emphasize sentiment indicators are secondary or even tertiary. They're not something to trade off of, but they are important to understand of how the crowd is thinking. This particular chart is the equity put call ratio. And this is actually a 2-year chart. And what I wanted to show you was, generally you want readings above 1 to show fear in the market and people basically buying more puts than calls. We have had a couple of spikes. The spikes are getting taller, which is positive. This is actually the highest spike we've had about a week ago, that we had from the COVID, from May of the 2020 year. So this is good that this is actually, I would not say it's extreme. I'd like to see it get higher, but I do think it's a positive sign to showing that some of the bullishness is slowly being wrung out of the market. This is the Vix indicator, and this I took directly from IBD's homepage. And IBD, what they do is they look at stretches of the VIX 20% above the 10-day moving average at a sign that the market could rally. And they mark that with these little red arrows. So, about a week ago, the VIX had spiked to just below 40, and that was 20% above the green line, which is the 10-day moving average. So they marked it as a possible inflection point where maybe we would get a rally. We've noticed that volatility has come back down in the past week, but it's something just to be aware of in the context when we look at some of the price and volume action. This is the NAAIM survey, active fund managers. It's a 2-week moving average of their exposure levels to the market. And you'll notice that exposure levels have been coming down since early November. The green, yellow, and pink are zones that I've put on my charts to help with, when you're above 80% invested, usually the market's somewhere, topping process. When this number is between 30 and 60%, it generally means we're in corrections, and market bottoms with bear markets, it might even get down to the 10 to 20% level, as we did see it touch it back in the COVID lows. So we're currently, somewhere in the 55% range, when we are in a correction. Could go lower, but it is noticeable that active managers have been pulling money slowly out of the market. So I wanted to get to probably the heart of this video is to talk about some market scenarios. There's a lot that's been happening, and a lot of people are trying to say, well, what's going to happen next? What's going to happen next? And what's most important is we just interpret what's going on in the market day to day. So this is the NASDAQ composite, and I wanted to share a couple things on this particular chart. It's a daily chart. And I've kind of captioned this as it's still early in this downdraft, and I'll speak why I mean that. What's important is when we came off the top, we had a break, and we kind of called, IBD has labeled these things vertical violations. And that was an 8% drop as we kind of sliced right through the 50-day moving average, and the 50-day eventually rolled over. Vertical violations are important. When you get a sharp slice like that, it typically takes the market a good period of time before it can recover. So it's indicating a certain amount of damage that's occurred in the market. And you'll notice from that violation, there was a brief weak rally, and then we've really waterfalled lower. And intraday, I think the NASDAQ was down 19.2%. And I had tweeted recently about we're waiting for the first rally off of this low, and we hadn't gotten it yet. And I want to talk about the first rally that we get off this low, and then the ensuing what kind of pullback we get is really an important x-ray into the market's health. Is the market actually firming up and getting healthier, or is the market still showing signs of further deterioration? Now, I noted on Friday was a pretty good day. On the NASDAQ, we had advancers leading the declining issues by 2-to-1, very positive. The advancing volume led the declining volume on a 3-to-1 basis, again, positive. And the new highs minus the new lows, which I watch pretty closely, while it's still a high number, it has dried up a little bit from the extreme levels we saw about a week ago. So I think the reading on the NASDAQ was about 1132. And from the initial lows we had over a week ago, we had reached a peak of almost 1737 new lows. We're really on day 5 of a rally attempt, and we haven't gotten it yet. But it's still early. We haven't even seen the rally to evaluate the market further. So I wanted to pull up some historical markets to try and look at some possible scenarios of what could happen and how could we use history. So let's look at this. And I'm going to show you three diagrammatic scenarios. One I'm going to use is the 2011 market. In the 2011 market, when the market peaked, it came down, hit a low. We had a first rally. And in the 2011 case, we came back to retest this low, which actually held, and the market kept moving higher, but it was fairly wide swings and choppy. So we're going to look at that market in detail in a moment. I also looked at the 2015-16 market top, and we had an initial low. And then in the 2015 market, the market tried to come all the way back up to the old highs fairly quickly and got turned away and actually came all the way back down and undercut the initial low before the market really gained its footing and found a durable bottom to launch a rally in 2016. Now we'll look at that in a moment. And in 1996, we had a peak in the market and we had a correction. And interesting, in 1996, we had a correction. We did not really have any retest or undercut of the lows, but the market made its way higher, and then it kind of had a digestion period, and then it moved higher into new high ground. So these three scenarios that I'm showing you, and we're going to look at the details, are basically trying to show a case that says, if these would say that we do not have a deep bear market in terms of some of the templates we might look at. Now, this could go the other way, such as 2018. Now in 2018, here's the 2018 market, and you'll notice the market had a top, had its initial low, then it doodled around for a little bit, and then made a second wave lower, tried to rally, and made a third wave lower. And that's very typical in bear markets to have what we call three waves down. And I've shown those three waves on the actual bar chart of the NASDAQ. This could happen. It's in the cards. We don't know where we're going to go from here, but I wanted to look at the scenarios that said, if the market were to stabilize, how could we see the signs that it was stabilizing? So here we are. This is the August-September 2011 bottom. You'll notice the first thing I've marked is there was a vertical violation off the top through the 50-day moving average. We came down 17% plus in only 10 days. Very, very sharp decline. And you'll notice that we did get our first rally off the initial low. And that's helpful to us as a marking point as we came back down. You'll notice as the market came back down and kind of retested the lows, every ensuing rally really had trouble getting through the initial rally off the lows. You can see there's actually 4 attempts, 1, 2, 3, and 4 failed attempts to get above the initial rally low. That tells us something. And those failures led to an undercut of the initial low. And that is a very scary undercut, as the crowd and many people will get very scared out of the market when they see this undercut. Now, the market in this case reversed higher and had a really strong reversal, and it started rallying. You'll notice that it rallied really strong, and it showed that it was strong because it got through this resistance point. But then it reached into this orange zone, which really was the old overhead supply from the market top that had formed, and the market got extremely choppy again, and we came back down. We came back down. We didn't come as low as we were before, but the market tried to rally again. And this is really an important, this point here, because this is really the second higher low that we've gotten as the markets tried to stabilize. And it's much less of a pullback in terms of the percentage of depth. So that represents change. And that's an important thing to notice on the chart. And you'll notice that after that, we actually got the follow-through day and stocks started breaking out. I've noticed in the background, we had a day 17 follow-through day. And then I've marked some of the leading stocks and where they broke out. Very soon after that follow-through day, a whole bunch of stocks have been setting up and were prepared to break out, which were confirming that we were really ready to make a move higher. Now, it's also important to note that the market made a new high over here. It was almost 8 months before the market reached a new high. That's quite a period of time, and we need to understand that sometimes these things do take time. So let's take another look. Now let's look at the 2015-2016 market. So in August of 2015, we had a vertical violation. We were down 15% plus in only 5 days. This was an extremely scary drop, and there really was some exhaustion selling at the bottom, very high volume on the selling on the way down. Now, here's the scenario. We actually rallied, had our initial rally, got back into the 200-day, and then we came back down. What was important is we'd retested some of these lows and we held. That's important to recognize that holding point. In this case, the market tried to rally very sharply back up to the old highs. And there were really a whole bunch of bulls that were still hoping for a fast, quick recovery. And anybody who was short got run in right here, creating this really, really sharp rally. But again, the market ran into a zone of overhead supply. You can see a lot of choppy trade for a number of months in this area before we went lower. And this is just too quick of a move sometimes. Sometimes a market can digest and then go higher. In this case, it broke down again. And you'll notice the market broke wide open again, and we came all the way down very, very quickly. And as all this was happening, I wanted to note there were numerous follow-through days, and I'm showing him here, 1, 2, 3, 4. There were 5 follow-through days during this 4 to 5 month period that were failed follow-through days. Eventually, this market came all the way back down to the initial lows. And again, undercut, very scary point in the market here. And this undercut is important because it shakes out any of the last bulls that might have been in this market. When you have a bull market for a number of years, it takes quite a bit of amount of time to really unwind all the bulls. And in this case, it took a double dip before the market actually regained its footing. And we finally got after the scary low, we got a day 4 follow-through day with a 2.3% advance. And the market did rally, corrected a bit. And then you'll remember, if you were trading at this time, in early July, late June is when Brexit happened. And that really ignited the market again to move into new high ground. But I will note that the new high to this market took almost 1 year from the time of the peak that occurred back in July of 2015. This was an extremely tough period in the market. Some people call it a stealth bull market, a stealth bear market. Certainly growth stocks were having an incredible difficult time during this particular period. So that's a scenario that you'd come down, you go back up, and then you come back down for a double test. Now, the third scenario is the 1996 bottom. And again, it started with a vertical violation, 7.5% in 6 days was the initial break off the top. Ultimately, this correction came all the way down almost 19.6% on an intraday basis. Now, using the same basic analysis, you had the initial rally off the low, which is really important to understand what's going to happen. And in this case, we immediately came back down and retested those lows, and they held. Positive sign. And you'll notice we retested the lows, and then we had a rally. And on that rally, we had a day 13 follow-through day. We ended up with a day 14, another follow-through day of 2.4, and day 17. So 3 very powerful days were an indication that maybe this was truly a durable low in the market. The next sign after those follow-through days that was really revealing was the market price action. You can see the spread start to really tighten up, and the market basically digests this thrust off the lows. This orange zone is important because it represents change. We go from volatile trading to a tight trading, and we're holding gains. And you'll also know that we recovered the 50-day and came back down, and we held the 50-day. Very positive sign that this might have some legs. And you'll notice the market did make its way higher. And in this case, in 96, it was about 4.5 months from the top of the correction before we reached new highs. So let's take a turn now to, in this period of the correction, you want to be building watch lists. Now, many stocks have come off 50% off their highs. So I wanted to just look at, literally look at the math, if you're a CanSlim investor, about what does it mean for a deep correction. Bill always talked about trying to avoid stocks that were 40, 50, 60% off their highs. So let's pretend that the peak of a stock was $100 and it's come off 50%. So it's now trading for $50 and the stock bottoms out. Now, typical CanSlim investing is we want to see a base build with an uptrend, a prior uptrend of at least 25 to 30% minimum in order to form a proper base. So if we bottomed at 50, a prior uptrend would actually take us to $65 per share. Now you'll notice that at $65 per share, you're still well off the old highs. Now let's assume that the stock builds a base. In this case, I've shown a flat base, a base that's maybe 15% deep. So from 65, you could correct in this base all the way back down to 55. So you'll notice that you've barely come up off the bottom as this stock is trying to form a proper base. So if you're trying to pick the bottom and you're trying to enter these stocks right off the bottom, you just have to be aware that if a stock comes up a bit and forms a base, you're probably going to be under some pressure. And eventually, you've got to get through the old overhead supply. And that's why some bases take quite a bit of time to clear the overhead supply when you've had deep 50% corrections. Now let's contrast that with a different scenario. There are stocks out there that have only corrected 20 to 30% off their highs. So if you had the same situation, a $100 stock that tops, comes down to 75, if you get a 20% move off the bottom to help form this base, this brings the stock up to roughly $90 a share. You're within striking distance now of the old highs. And if the stock were to form a 10% handle in here, maybe the stock comes back to 82, you can just see how this is a tighter formation. And again, you might find an early pivot line, a descending trend line. That's why we do ideally want to find bases that are 20 to 30%, not the super 50% deep bases, if possible. So it's just, keep that in mind as you build your watch list. So trying to wrap up here, the facts are that 70% of the NASDAQ has corrected a minimum of 20%. That's a lot. Now, 45% of the NASDAQ has corrected 50% minimum. So those are just facts right now. There's been a lot of damage in the NASDAQ composite. So as we mentioned, building your watch lists, you want to see stocks building quality bases at least 7 weeks long. All the market examples we looked at, the general market needed 4 to 12 months to actually rebuild itself before it actually got into new high ground. So there's a certain amount of patience that is going to be required. We'll need a follow-through day to get more bullish, but I mentioned there can be failed follow-through days. So you want to pay attention to those follow-through days. But more importantly is when you get the follow-through day, you want to look at the leadership. Are there quality stocks that have formed quality bases that are under accumulation to help you with your expectation that this rally might have legs? A follow-through day with no bases and everything way down deep in the pattern has less of a chance of succeeding. Doesn't mean it can't be successful, but the odds are much less. Now, the market break that we showed, it's obvious to everyone now. We call this kind of from a sentiment point of view, the disbelief phase. We dropped really quickly in a short amount of time. We're still waiting for the first rally off the initial low. So we need to see that because it's going to give us a lot more information as we look at the quality of that rally in terms of leadership and volume and breadth. Now, we could get some more panic selling. We could get an undercut of those lows, and maybe we follow the script of the 2018 market. We don't know. A lot of people are out there talking about wanting to short. In my opinion, it's way too obvious to short right now. The timing is not right. We're way below the moving averages. So shorting is difficult to begin with. It's not the right timing to be shorting. Now, if we get a really weak rally into some resistance points, maybe shorting becomes more attractive. So what do we do right now? Well, we observe. We're going to observe the market action and stay engaged with the market. We want to interpret. No one knows where this is going to go, but we have covered some scenarios from 96, 2011, 2015. So the point of doing that is to share with you some templates of where the market could go. So be open. So as we see this develop, you might see it start to fit one of the templates. The first rally, we might get the first rally next week because of the strength we saw on Friday. In future videos, maybe in 2 weeks, we'll look at some more signs that I look at to really tell if we have a market bottom, a durable market bottom in place. But we're still pretty early in this correction. But I wanted to give you some thoughts of what I was seeing and thinking. I thank you all again for joining me today. I hope this is helpful to you. Always looking forward to feedback and comments. Here's my Twitter here. Join my YouTube channel. I'll try to put out videos every couple of weeks. Thanks again, and we'll see you soon on the next video.